Hey, welcome back. It's Jason Walter here, and here's your latest housing market update. In today's video, I want to share an update from the Mortgage Bankers Association, or the MBA. They stated that mortgage applications increased yet again this week. However, mortgage applications for home purchases actually decreased. So with that said, let's go ahead and dive right in the video. I also have some news regarding lenders actually tightening their standards for lending out loans right now. So more on that here in just a little bit. But first, let's talk about this. Mortgage applications increased in the latest MBA survey here, and this is for the week ending August 5th. So total mortgage applications only increased by 0.2% from 1 week ago. This includes refis plus purchases. So the refi index actually increased 4% from the previous week. This is pretty unusual because this index has basically been decreasing for quite some time, because of course mortgage rates have been increasing. But compared to 1 year ago, of course, applications for refis have basically fallen off the cliff because mortgage rates have increased greatly from 1 year ago. So let's talk a little bit about this 4% increase in refis, because I'm kind of scratching my head regarding this because mortgage rates 1 year ago were around 3%. On January 1st, they were also around 3.3%. So rates right now are above 5%, and so it's kind of unusual that people are refining right now. And the reason why we may be seeing some people doing refis right now is because of this. So the average 30-year fix, as you guys all know if you guys follow the channel, reached a year-to-date high of around 6.28% in the middle of June, June 14th to be exact. But for the week ending August 5th, which again is when this survey was conducted here, the week ending August 5th, mortgage rates were more or less all over the place, but they actually hit lows of around 5% on August 1st, which was Monday, and also on Thursday, August 4th, when rates were about 5.09%. These rates, by the way, at 5.09% were more or less the lowest levels we've seen since April this year. And because mortgage rates hit a 4-month low, this could be one reason why they saw an uptick in refis. And these rates at 5.09% were approximately 1.1 percentage points less than the highs we saw on June 14th. All right, that was refis. Let's talk about purchases though, because the MBA has what's called the purchase index, which of course is an index based on the number of people submitting loan applications for home purchases. So the purchase index actually decreased 2% from 1 week ago and was down 19% from the same week 1 year ago. And according to Joel Kahn, who's one of the MBA's associate vice presidents, he basically stated that mortgage rates were very volatile last week here. And you actually go back to this chart here, you can see this. Because on August 1st, rates were at 5.05%, then they increased on Wednesday to 5.50%, then decreased again to 5.09% on Thursday, and then again increased on Friday to 5.45%. So rates were absolutely all over the place last week. And Joel Kahn goes on to say the following here. The purchase market continues to experience a slowdown despite a strong jobs market. Activity has now fallen in 5 out of the last 6 weeks. More on that here in just a little bit, as buyers remain on the sidelines due to still challenging affordability conditions and doubts about the strength of this economy. And I'm kind of laughing about this quote here because they say here activity has now fallen in 5 out of the last 6 weeks. If you guys recall from a video I made a couple of days ago, Redfin reported on August 5th, which was about 5 days ago actually, they say early stage demand picks up as mortgage rates fall to a 4-month low. And one reason they cite here is because mortgage applications rose, but they only rose by 1%. And that was the first time in 4 weeks that they actually increased. But now they decreased once again, and they have now fallen 5 out of the last 6 weeks. What I'm getting at is when Redfin states that early stage demand is picking up, and one of those reasons is because mortgage applications actually rose, that was a very short-term trend that was reversed in this latest survey from the MBA. In regards to a statement here that we still have challenging affordability conditions, have a look at this. If you were to buy the median price home 1 year ago, that would cost you $366,900. That's according to the National Association of Realtors on Uncle Fred's website here. Again, for June 2021, $366,900 for the median price home 1 year ago. 1 year ago, rates were actually at 2.99%. Let's look at that. So 1 year ago today, which is the August 10th, rates were at 2.99%. So if you were to put 20% down, your housing payment, which would be principal and interest only, would be $1,235 per month. But fast forward 1 year, home prices increase to $416,000. By the way, this is the latest news we have from the National Association of Realtors. At the time of this video, they have not published July's numbers yet. So I'm looking at June to June. So June 2022, the median home price was at $416,000. 20% down payment. And again, the current rate right now, as of today, which is August 10th, was 5.13%. So your new housing payment would be $1,813 per month. In other words, your housing payment would be $577 more per month. And that payment would be $577 more per month in order to buy the same median price home in America right now. So what this means for home buyers is that it would cost them 47% more for their housing payment to buy basically the same house right now, or in June 2022, compared to June 2021. And because of this, we have a housing affordability issue, which is one big reason why we've seen this pullback in home buying demand. All right, so going back to this report from the MBA, for the week ending August 5th, the adjustable rate mortgage share of activity decreased to 7.4% of total applications. So these are adjustable rate mortgages here, decreasing to 7.4%. I believe the year-to-date high was around 12% that was set about a month or two ago. And also on January 1st of this year, this share was around 3%. So the share right now is more than double the rate we had back in January of this year. But obviously, this has been decreasing, which is a positive sign because this is more of a risky loan product than a 30-year fix, for example. And the reason why, in my opinion, why this has been decreasing for the share of people submitting loan applications for ARMs is because of this. The average 30-year fixed rate mortgage for this time period here, the week ending August 5th, was 5.47%. But for a 5/1 ARM, this means that your rate is fixed for 5 years and then it becomes variable thereafter. That rate is actually 4.60%. So that spread there is around 0.9%. Over the past couple of weeks, or past couple of months, I should say, that spread has been in the range of 1 to 1.1%. So this spread is actually less than 1%, which in my personal opinion is why we're seeing this decrease in people submitting loan applications for ARMs. Okay, changing gears slightly, let's talk about the latest report from the MBA, which was just published yesterday. They state here that mortgage credit availability decreased in July. So actually decreased in July, and this is what they call the Mortgage Credit Availability Index, or their MCAI. That actually fell fairly significantly compared to June because it fell by 9% in July. And by the way, a decline in this index here indicates that lending standards are tightening. In other words, it becomes more challenging to get a loan approved if you're looking to buy a house or do a refi, for example. I found this to be very interesting because this is far different compared to 2005 and 2006, right up to the Great Recession here, where lending standards were very, very loose. You can get ninja loans, you can get a loan without even proving your income, for example. But now we have a slowdown in our housing market right now. But unlike 2005 and 2006, lenders right now are actually tightening their lending standards right now. And according to Joel Kahn, credit availability fell last month to the lowest level since May 2013. The 9% decline in the July index was the largest monthly decline since April 2020. And here's a graphic showing their index over time, ever since 2011, I should say. So the current levels right now are the lowest levels since May 2013 right here. Interesting enough, credit availability actually was loosening until we hit this pandemic here. So basically in around 2020 or early parts of 2020, lending standards absolutely tightened greatly. So it became more challenging to get a loan at the onset of this pandemic. This basically absolutely plummeted here for the first half of 2020. But we're still actually below that level though, and the lowest level since May 2013. In my personal opinion, this is really good news because during a market where we have a downturn in our housing market, if lending standards were basically going straight up, meaning lending standards were becoming very, very loose, that would be a recipe for disaster, just like we had during the Great Recession in 2008. And with that said, let me show you what I actually mean here, because here's our index ever since June 2004. As you guys can see here, from 2005 to 2006, lending standards absolutely skyrocketed, meaning that lending became very, very loose, which is one of the main reasons why we had this giant fallback in our housing market in 2008. But fast forward to now, lending standards are very, very tight. The index at 108.8, again, the lowest levels we had since May 2013. In other words, very tight lending standards ever since May 2013. And also far less than 2004 all the way until 2007, because look at that. The peak was basically almost at 900. Now we're at 108.8. Now, I'm not saying that our housing market right now is not without its challenges, though, because one of the main reasons, in my personal opinion, is due to a lack of housing affordability, which is causing home buyers to really back off of this housing market. But comment below what your biggest takeaways from today's video. Also, if you got any value out of this video whatsoever, then please hit the like button. I greatly appreciate that. Hope you guys have an awesome day and look forward to seeing you on the next video.